$16,395. That's Diane's homeowners insurance bill in Miami-Dade. $2,526. Same size house, same Florida, 200 miles north in Tallahassee. She's 67, retired, on a fixed income, and Florida just charged her 2 different prices for being Florida. Now picture Georgia asking a different question entirely. Diane is a retired teacher. $42,000 a year in pension, $28,000 in Social Security, a $400,000 house she already owns free and clear. She has narrowed her move down to 2 states, Georgia and Florida, the same 2 states that show up in almost every retirement search this year for the same 2 reasons: warm winters and a reputation for going easy on a fixed income. And like almost everyone doing this math, she started in the wrong place. Here's the wrong place. Florida has no income tax, so Florida wins. That line shows up in nearly every video comparing these 2 states. Nobody in those videos ever runs the math for one named retiree, and Diane's math turns out to say something different. So before we touch a single county line or a single insurance quote, let's settle her income tax bill in both states, because that's the number everyone assumes and almost nobody calculates. Georgia taxes retirement income. That part is true, but Georgia also lets anyone 65 or older exclude $65,000 of retirement income per person from state tax, and Georgia never taxes Social Security. No exceptions. Diane's pension is $42,000, comfortably under that $65,000 exclusion. Add her $28,000 in Social Security, which Georgia doesn't touch regardless of the amount, and her entire income, all $70,000 of it, owes Georgia nothing. 0. The same as Florida. So the income tax question, the one that decides this comparison in almost every other video on this topic, is a tie for Diane. $0 in Georgia. $0 in Florida. If you're retiring on a pension and Social Security under that exclusion ceiling, no income tax isn't a reason to pick Florida over Georgia. It's a reason to stop treating that one line as the whole decision. That said, the exclusion has a ceiling, and it matters who you are. Georgia's flat income tax rate sits right around 5% on income above that $65,000 per person threshold. If your pension or your IRA withdrawals run higher than Diane's, say $90,000 or $100,000 a year instead of $42,000, Georgia does start taking a real bite above that line, while Florida still takes nothing no matter how large the number gets. So the tie holds for a retiree shaped like Diane. It doesn't hold for everyone, and that's worth checking against your own number before you assume it applies to you too. Property tax is next, and at the state level, it's almost as much of a wash. Georgia's average effective property tax rate runs right around 0.75%. Florida's statewide average sits close enough to that same range that which state comes out cheaper depends on which year and which source you're reading, not on anything Diane can bank on with confidence. On her $400,000 home, that's roughly $3,000 a year in Georgia before any senior break, and Florida lands in a similar neighborhood before its own protections kick in. That statewide number is where almost every other video on this topic stops talking. It's also exactly where Diane's actual decision starts. Because in Georgia, property tax isn't a state number, it's a county number, and the gap between counties is bigger than the gap between the 2 states. That gap exists for a structural reason. Georgia funds public schools mostly through local property tax, set and voted on county by county, not through one statewide formula. Every county's school board sets its own millage rate, and every county's commission decides its own senior exemption on top of that, which means 2 houses worth the same money, 20 minutes apart, can owe wildly different school tax bills depending only on which side of a county line the driveway sits on. Florida doesn't work this way. Florida's homestead exemption and its Save Our Homes assessment cap apply the same way in every county, which is part of why Florida's property tax picture is comparatively predictable and Georgia's is not. Picture a plain map of Georgia, cut into more than 100 counties, each one drawing its own line. Walk it county by county now, run against a woman with Diane's exact income, not a state average. A homeowner 65 or older in Cobb County, just northwest of Atlanta on that map, keeps 100% of the school portion of their property tax bill exempt under a standing county ordinance. School tax typically runs 60 to 70% of a Georgia property tax bill, so on Diane's roughly $3,000 bill, that exemption would knock her down to somewhere around $1,000 a year, county and other local taxes only, with no school portion left at all. A house further north of Atlanta, in Forsyth County, gets something almost identical, and it may be the most generous exemption on this list. At 65, homeowners there are exempt from 100% of the school district's operating tax and its school bond tax. The detail that tends to surprise people, there is no income limit attached to it at all. Diane doesn't have to prove she's under any ceiling. She just has to be 65 and file by April 1st. Same result as Cobb's, roughly $1,000 a year, give or take, once the school portion disappears entirely. Northeast of Atlanta, in Gwinnett County, a program called L5A does something similar. A full 100% exemption from school board tax at 65, with an income cap a little over $124,000 in Georgia taxable income for the year. Diane's income of $70,000 doesn't come close to that ceiling, so she clears it easily. There's also a second option for homeowners as young as 62, a partial exemption capped at a much lower $10,000 income limit, for anyone who wants the break earlier but doesn't need the full L5A weight. All three of those counties land at roughly the same result, a full school TX swipe at 65. But they're not interchangeable places to live day to day. One sits closest to Atlanta with the shortest commute, one trades a longer drive for newer housing and faster growth. One is the most diverse and built out with the widest range of home prices. Same tax outcome, three different day-to-day lives. And that's a decision that this video can hand her the numbers for, not make for her. Now here's where it stops being simple, because this is exactly the part every "just moved to Georgia for the tax break" video skips over. Fulton County, the county that includes Atlanta, does not offer that same full exemption. At 65 to 69, Fulton exempts 25% of a home's assessed value from school tax. At 70 and older, that climbs to 50%. There's no income cap either way, which sounds generous until you set it beside the three counties above zeroing the school bill out completely. For Diane, at 67, that 25% knocks a few $100s off her roughly $3,000 bill. Real money, but nowhere near what her neighbors one county over are keeping. That's the arithmetic behind the comment that keeps showing up under almost every Georgia retirement video. Some version of "I barely live on the edge of Fulton County and the taxes are ridiculous. Worst county in the state." Fulton offers less, and later, at 65 instead of full relief, than the counties surrounding it, and when the exact same house one county over pays a third of the bill. Worse in the state stops sounding like an exaggeration and starts sounding like someone who did the math the hard way after closing. If you've ever lived in Fulton and felt that in your own tax bill, say so in the comments, because that's the complaint this section just ran the numbers on. And subscribe now if real county numbers over state averages are useful to you, because Florida's version of that same problem is next, and it's a bigger swing than anything Georgia just showed you. Up near Gainesville in North Georgia, Hall County lands in between. At 65, as long as her combined Social Security and pension income stays under roughly $100,000, which Diane's does easily, a homeowner there gets $32,000, plus the standard homestead exemption, knocked off the taxable value used to calculate school tax. That's a meaningful cut, well short of the full wipe those same three counties hand out, since it shrinks the number the school tax gets calculated on, rather than zeroing it out. And Hall's income cap is the one worth watching closest of the seven, since it's the only county on this list that could shut Diane out entirely if her income ran even modestly higher than it does. The last two counties are the ones worth a phone call before you rule anything in or out. Just east of Atlanta, Cobb is the most layered of the seven. It runs several tiers by age and by income, from a full school tax exemption at the lowest income bracket down to partial exemptions in the range of $15,000 to $20,000, with a more generous tier opening up at 70. Exactly where Diane lands depends on how the county counts her income against each tier's cap, and that's a question only the local tax commissioner's office can answer for her exact numbers. North of Atlanta, Cherokee is the county that started this whole conversation in the first place. the one that shows up over and over in comment sections under Georgia retirement videos, described as cutting a senior's school tax by around 70% at 62. That figure is real and widely reported, but the residency and income fine print behind it is less consistently reported than the ones already covered. So if Cherokee is on Diane's list, it earns that same phone call. Add it up, and here's what happens in the end to Diane's roughly $3,000 Georgia property tax bill, depending only on which side of a county line she buys on. In Cobb, Forsyth, or Gwinnett, about $1,000. In Fulton, roughly $2,500. In Hall, somewhere in between. In DeKalb, a phone call away from knowing. Same house, same income, same state. A $2,000 swing that has nothing to do with Georgia versus Florida, and everything to do with which side of a county line she signs on. That's Georgia's real story, not a state number, a map. Now here's Florida's, and it's the one nobody selling a house in Florida wants to walk through first. Florida's homeowners insurance market isn't one price. In Miami-Dade, Diane's exact house, same size, same value as the one she's pricing in Georgia, runs about $16,395 a year in homeowners insurance. Drive 200 miles north to Tallahassee, same house, same coverage, and that number drops to $2,526. That's a $13,869 gap inside one state, before Georgia enters the conversation at all. The reason comes down to geography. Coastal Florida carries hurricane and flood exposure that inland Florida simply doesn't. The state requires homeowners in the highest risk areas to choose a hurricane deductible, and depending on the option, that can run anywhere from $500 up to 10% of the home's insured value. On a house like Diane's, that range works out to somewhere between $7,000 and $35,000, just for the deductible, before a single dollar of the claim itself gets paid. And wind coverage, in a lot of coastal Florida, isn't bundled into the regular policy at all. It's sold separately, its own policy, stacked on top of everything else. Flood maps change too, and not always in the homeowner's favor. A house that was drawn outside a high-risk flood zone a decade ago can be redrawn inside one after a remapping, which can force flood coverage that wasn't required, or priced the same way when the original owner bought the place. Insurers do offer credits for storm hardening a home that can knock meaningful money off a coastal premium, but those credits reduce the bill. They don't erase the underlying risk pricing that separates Miami-Dade from Tallahassee in the first place. Price the hurricane risk itself as its own line, not a footnote buried inside insurance. Florida's state-backed insurer of last resort, Citizens Property Insurance, was still carrying close to 295,000 active policies as of this spring. Homeowners the private market wouldn't fully take on at any price. Georgia and Tennessee don't run anything comparable because they don't need to. Storms happen inland too, but the hurricane and flood math driving Florida's coastal premiums simply isn't the same risk pool Georgia's insurers are pricing against. So if Diane buys in Tallahassee, her Florida insurance bill looks a lot like a Georgia bill. If she buys in Miami-Dade, it doesn't, and no property tax exemption in any Georgia county comes close to covering a $13,000 swing that lives entirely inside Florida's own insurance market. Sit with that for a second, because it's the number underneath everything else in this video. The gap between the cheapest Georgia county exemption and the most expensive one, Cobb versus Fulton, is around $1,500 a year. The gap between the two Floridas, Tallahassee versus Miami-Dade, is nearly 10 times that. Two homes, same state, same insurance market, and the distance between them in cost is bigger than the entire Georgia versus Florida question this video started with. That's not a Georgia problem or a Florida problem. It's a which address problem, and it's the one number every state versus state video skips because it doesn't fit neatly into a title. Healthcare is the next piece, and it deserves names, not adjectives, for the same reason the property tax section did. A state-level answer hides a county-level truth. In and around Atlanta, Diane would be within reach of Emory, Piedmont, and Northside, all three inside the same county cluster that already decides her tax bill. So the line she's weighing for the school exemption is the same line that decides how far she drives for a cardiologist. Head north toward Gainesville, and the Northeast Georgia health system is considered one of the stronger community hospital networks in the country. Well regarded enough that people have chosen North Georgia over other parts of the state specifically for it. Augusta and Savannah both carry solid hospital networks of their own too, if either ends up on the list. The trade-off sits in rural Georgia, not the state as a whole. Some smaller, more remote hospitals have closed in recent years, meaning a longer drive for specialty care the farther out Diane goes. And that's the honest trade-off behind Georgia's lower cost of living outside the Atlanta metro. Cheaper often means farther from a hospital, worth pricing in alongside the county tax numbers above. In Florida, Tallahassee Memorial anchors the capital, and Miami's major hospital systems are some of the largest in the country. Florida overall carries more medical infrastructure built around retirees than almost anywhere else in the United States, for the obvious reason that more retirees already live there. The trade-off there is scheduling. When most of your neighbors are also retired and also seeing the same specialists, appointment backlogs are real and worth asking about directly before you sign anything, not assumed away because the hospital itself has a good reputation. You'll notice this comparison leaves out a third state that shows up constantly in the same searches: Tennessee. That's deliberate. Tennessee's pitch is real: low property tax and no income tax on wages. But stacking a third state into this comparison mostly just crowds out the two mechanics that matter most for someone shaped like Diane: which Georgia county she buys in, and which Florida zip code she insures in. Tennessee's own version of this math is a video worth making. It just isn't this one. One more line item worth naming plainly before the recap: sales tax. It won't move the needle like insurance does, but it's real money over a year. Georgia runs somewhere around 7 to 9% depending on the county, once state and local rates are combined. Florida runs closer to 6.5 to 8%, again depending on the county. Neither state is dramatically worse than the other here. It's a rounding error next to a $13,000 insurance swing, but it's still a number worth having before moving day, not after. So here's Diane's actual arithmetic, side by side, not adjectives, not vibes. Income tax, 0 in both states, a tie, because her income sits under Georgia's exclusion ceiling. Property tax, a wash at the state level, but inside Georgia, it swings by roughly $2,000 a year, depending entirely on which county she buys in. In Cobb, Forsyth, or Gwinnett, about $1,000. In Fulton, roughly $2,500. In Hall, somewhere in between. In DeKalb, a phone call away from knowing. Insurance, the one number that dwarfs all of that, because Florida alone can cost her anywhere from $2,500 to over $16,000 a year for the exact same house, depending only on which Florida she lands in. And that's before either state's healthcare access or its sales tax even factor in. None of this tells Diane where to move. It tells her what to check before she does, which county's school exemption she qualifies for if Georgia's on the list, and which Florida zip code's insurance quote she gets before she signs anything, not after. Georgia versus Florida was never really the question here. The county line and the zip code were. Every number in this video traces back to a public source: a county tax commissioner's own exemption page, a state insurance regulator's deductible rules, a hospital system's own service area. None of it is locked behind a call to an agent or a login, and none of it required guessing at a state average when a named county or a named zip code would give the true number instead. Before you sign anything, call that county's own tax office and ask what your exact bill looks like at your exact income, and get a real homeowners insurance quote for the exact address you're considering, not a statewide average pulled from an article written for a different retiree entirely. Both calls take about 15 minutes each, and both numbers move this decision more than anything a generic moving guide will ever tell you, because a generic guide is averaging over exactly the two things this video just showed you. Don't average well: a Georgia county line and a Florida zip code. If you're running the same math for your own retirement, tell us in the comments which number surprised you most: the county swing inside Georgia or the insurance swing inside Florida. And if you want the next breakdown in this series before it's out, go ahead and subscribe now, because the next one runs these same 7 counties against a couple filing jointly instead of a single retiree. And the exclusion math changes completely once there are 2 incomes on the return instead of 1. We'll leave the moving truck out of it, and we'll leave the sales pitch out of it too. This is just the arithmetic, run against 1 named income and 1 named home value instead of a state average that fits nobody exactly. Where you land is still your call.